All right, hello there. Welcome to this wonderful course, the intermediary course. We begin with nothing other than delving deep into the things that we started, but we did not handle them in depth. We just introduced them in the beginners. Now, when we come to the intermediary course, we get to a place where we actually deal with them in a bit more detail. Now, that's why we are inviting you to the intermediary course, and we wanted to get into this first thing, use of indicators for technical analysis. Remember, friends, that technical analysis is one of the key things that we have to learn how to deal with when we are traders. We have to do we said that they are the fundamental analysis that we have to take on a different time and about different pairs and about different commodities. Before we trade, we first of all look at the fundamentals, then we look at the technicals. In the intermediary class, what we are going to be doing is going into the depth of what do we look at when we're looking at the technicals. So one of the things that we have begun with in the technicals here is we are starting with indicators. We want to understand which indicators should I use. I'm not here to advise you on which indicator you should use, but I am here to talk to you about several indicators and begin to show you how indicators work. How do they calculate what they calculate? There are people who don't depend on indicators. However, in these lessons, you will learn about them. Then it will be up to you whether you want to use them or not. So let's dive right now into them and find out what are these indicators and how can I begin to use them. But before we even move into the particular indicators, because I will split these indicators, I will talk about several of them individually. Let us first of all deal with this question. Should we or should we not use indicators? Because it's a very pertinent question. The people who don't use them, why is it that they don't use them? What is it that causes them not to use indicators? Oh, let's move in and see. Now, forex indicators are tools. What are they? They are tools used by traders to analyze and interpret data in order to make informed decisions about buying and selling currencies. Okay, there are various kinds of indicators, among them volume indicators, volatility indicators, momentum indicators, trend indicators, and others. So you can see that there's a wide range of things that these indicators look at. All right, indicators are tools to get more information. I think I need to get this out of your way so that you can be able to see that part. Indicators are tools to get more information than that which is given by candles. So candles do give us information, but we want more information. They, however, give lagging data of what has happened to price over a given past period and based on different calculation formulas determined by the programmers who design the indicator. So these indicators are designed by programmers, or they are designed by uh, 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 people who look at certain parameters. There are certain things that they are looking out for. And so they come up with a formula and a calculation. You can also do the same. You can begin to set out your own indicators and look at the various things that you want identified, and move on and probably even develop your own strategy based on a certain indicator. Now, let's move in so that we can be able to see what these indicators are about. Indicators display in different forms. Mainly, they are what we call oscillators. An oscillation is the repetitive or periodic variation, typically in time, of some measure about a central value, often a point of equilibrium, or between two or more different states. So that oscillation is like a curve going up and down. That particular movement is what we're talking about as an oscillation. So indicators can display on your screen as an oscillation. Then they can also display as a histogram. A histogram is a chart that plots the distribution values. Okay, so it plots the distribution of a numeric, or rather of numeric variables or values, as a series of bars. So it comes out as small bars. Some are smaller bars, some are longer bars. We should have had a diagram of a histogram here, but I guess as we move on, we will see a histogram somewhere. So they can be oscillations, and they can also be um, they can be oscillations, that line with the curves, or it can also have histogram and as a bar. Either it can be displayed on the uh, price candles, or you can have a separate bar at the bottom. And we did some of these things in the introductory beginners course. You can go back. It doesn't hurt. It's very good to go back and go through the topic we had of indicators. It was probably in module 3 or 4. We dealt with indicators after dealing with candles. Okay, let's move ahead and look at major and most used indicators. Now, moving averages. You have got to remember about moving averages, because they are what you call simple moving averages, SMA, which calculate the average closing price over a specified time period. It helps identify the direction of a trend. So these moving averages are what we're going to be dealing with here in this particular module, or rather this particular lesson. Okay, exponential moving average, EMA. It is similar to the simple moving average, but it gives more weight to recent prices, making it more responsive to price changes. Okay, moving average, convergence, divergence. That's MACD. We are going to be dealing with that one in this particular module. I think in the next two lessons, we're going to deal with MACD by itself. We're going to split out to deal with several indicators here. All right, then we move on. There's Bollinger Bands. We're going to deal with it. I think that's the last, no, the second last indicator that we'll deal with. Then there's the RSI. RSI is the one we're going to deal with immediately. After this overview, the next lesson you're going to see is the RSI, because it's a very important indication in the market as analysis, technical analysis. So what does it do? It measures the strength and the speed and momentum of price movements. We will deal with it. There's stochastic oscillator. You may have to do this by yourself in your own free time. Go through that as a indicator. Find out about it and what it does. Parabolic SAR, stop, SAR, stop and reverse. I will not go through this in this particular module, but you can learn some of this when I deal with some of them. For instance, when we deal with relative strength index, the knowledge that you get the knowledge that you'll be able to get in RSI, you'll understand how the parabolic SAR calculates, because you already know what it does in RSI. That's the whole idea, that we can't deal with everything, but the things that we will deal with will be a pointer for you. They will be able to show you. They will indicate. They will tell you what an indicator does, and you will be able to see, because there are so many. There are hundreds of indicators, and indicators are coming up every day. So the idea here is know several of the major ones and the key ones, then, or the foundational ones, then identify to be using them, choose the ones you want to be using, and then in the future, as new ones are created, you'll be able to employ the ones you feel will be working with your strategy. So let's carry on and have a look at what to expect. These are just the major and the most used indicators. I have added here the Fibonacci at the bottom there. Fibonacci retracement. We will deal with this one because it's one of the major tools that are dealt with in trading, and also, where placing your stop loss or your take profit level is concerned. We're going to have a whole lesson on the Fibonacci, and it's going to be good. It's going to be interesting. Now, indicators, do we use or don't we use them? I've mentioned about this earlier in this particular lesson, but the debate of whether to use indicators in forex trading is ongoing among traders. Some swear by them, arguing that indicators provide valuable insights into market dynamics, helping to identify trends, gauge momentum and assets, and assess volatility. Others, by the way, I'm in that group that stand with indicators. Others advocate for a more minimalist approach. They don't want to use them. They rely on price action and fundamental analysis alone. Okay, it's up to them. That's their way, that's their style. All right, the second paragraph here says proponents of indicators argue that these tools offer objective and systematic methods for analyzing market data, providing clear signals for entry and exit points. Yeah, and I think that's true. By utilizing indicators, traders can develop trading strategies with predefined rules, reducing emotional bias and improving consistency in decision making. So, in this particular module, I'm going to deal with the several indicators. Now, you look at what they are checking. They are checking the volatility. They are checking momentum. They are checking the trend. And indeed, there are other ways of checking the trend. I am aware. I am very much aware that there are other ways of checking the trend. But if at all the indicator is already showing you that, it doesn't hurt. Just use it as an added advantage. So remember, we talked about confluence. We talked about looking at several things and making sure that all those things are agreeing with one another. That's the whole idea here. We're saying that know these indicators, and then employ the ones you want to employ, use the ones you want to use, and to whatever extent you want to use. So uh, uh, that's the whole thing. There's an argument going on, but the idea is to make money. So let's make money. Let's know about these indicators and let's make that money. Critics of indicators often highlight their limitations, including the lagging signals. Yeah, they say that these ones they're giving information when it's too late. Okay, and they give false positives and overcomplication of trading systems. They argue that relying too heavily on indicators can lead to missed opportunities and trading paralysis as traders become overwhelmed with conflicting signals. Now, at this juncture, let me go ahead and agree and say that it's true. Don't spend all your time on indicators. Don't spend all your time trying to decipher what volatility is in the market here. What volume? Sometimes you have got to shut down those things and just go ahead and make a position known. Go ahead and buy or sell. Go ahead and do the trade. You can't spend all your time because they are time consuming when you're studying, when you're researching. But there's a reason why you need to study them. You check and put your ideas together and then make your move. So sometimes there are people who will say we don't want to use this because they have a way of taking your time, too much of your time, and making you not progress. So the next part there, the next chapter there, second chapter, basically it says ultimately the decision to use indicators boils down to individual trading styles, preferences, and goals. Some traders find success in incorporating indicators into their strategies, while others prefer a more simplified approach. More simplified approach. Regardless of the choice, it's essential for traders to thoroughly understand the indicators they use, test them rigorously, and integrate them thoroughly into their overall approach. So, what you're saying here is, you know, as you progress as a trader, you'll be able to decide that I will not be using um, indicators when I'm dealing with this particular asset. But when I move to another asset, like for instance, you can decide for your cryptocurrency trading, you're not going to use some of these indicators, but you will just use market structure. So you use market structure and it's all good. So those are the things that we're talking about in this particular portion, and those are the things we are trying to bring about so that you can understand them. So find out by learning them. Once you've learned them, once you've known what they do, what they calculate, then you can be able to determine which direction you will go. Here's an explanation of some common forex indicators related to volume, volatility, momentum, and trend. Now, friends, this is what you need to notice. You need to understand something here. You need to understand that those particular things we're mentioning here are very crucial. Those are very crucial things that we are mentioning here. We're talking about volume. We're talking about the volatility of the market, the momentum of the market, and the trend. Those are the key things. When you listen to the news, those are the things that you need to catch on particular, uh, excuse me, when you're dealing with a particular pair or a particular asset. But what happens is that now the indicators, they are able to show you these things. They're able to calculate, and you don't need to understand the formula. You just need to understand how that particular indicator works, and then you employ how it works into your system. So quickly, let me just mention something about each of these. Now, the volume in forex trading, volume refers to the total number of transactions executed during a specific period. However, unlike in the stock market where volume is readily available, forex trading occurs in a decentralized market, making it challenging to measure volume accurately. Nevertheless, some platforms provide volume data based on the number of ticks or transactions. High volume, why do we think about volume? High volume can indicate increased liquidity and interest in a particular currency pair, suggesting potential stronger price movements. So it's good to know about the volume because high volume will indicate that liquidity. Then there's volatility. When you come to volatility, we read, or rather we have it here in the paragraph, volatility measures the degree of variation in the price of a currency pair over time. High volatility implies large price fluctuations, while low volatility indicates smaller price movements. Okay, volatility indicates, or rather, volatility indicators help traders assess the market's stability and potential risk. Examples of volatility indicators include Bollinger Bands, which we will deal with in this particular module 1. Then there's average true range. That's another kind of indicator. Then there's volatility index. So there are various there are various there are various indicators which all show different things, and volume is one of the things we try and catch. Volatility is another thing we try and catch. I guess there's something else we should try and catch. We should try and catch momentum. There we go. Momentum indicators, they gauge the strength or weakness of price movements. They help traders identify the speed at which prices are changing and whether a trend is likely to continue or reverse. Common momentum indicators include relative strength index, that is RSI, which we're going to deal with in the next lesson. Moving average convergence and divergence, MACD, which we will also deal with in the following or the next lesson. And the stochastic oscillator, you can find out about that one. It's also one of the indicators that deal with momentum. Okay, these indicators generate signals based on the relationship between the current and past prices, indicating whether an asset is overbought or oversold. It is in the market, yes, has it been overbought or oversold? So this is the purpose of these indicators. So we're going to be able to venture into some, or rather we're going to venture into two of these indicators mentioned here. It's going to be good. Then we're also going to deal with the trend. Okay, there are indicators that deal with trend. The indicators that deal with trend, let's read here. Trend indicators identify the direction of price movements over time. They help traders determine whether a currency pair is trending upwards, downwards, or moving sideways. Trend following indicators such as moving averages, e.g. simple moving average or exponential moving average, and trend lines are used to confirm the prevailing trend and potential entry or exit points. Additionally, oscillators like the average directional index, ADX, can help traders measure the strength of a trend. Now, I don't want to get you confused because there are so many kinds of indicators, but just understand that when you understand the few that we will deal with in this particular module, then you can be able to look at what do the others check. And depending on your strategy, that's the key, that your strategy is what determines what indicator are you going to use, because that indicator is supposed to raise the alert for you to know that a particular feature that you're looking for is on. Like for instance, when you talk about trend, true, you can use market structure to find the trend, because it will be those particular lines that you will draw, higher highs and higher lows, etc. But there are sometimes you are just checking the trend in a more difficult circumstance where it's not very clear where the market is going, and you're trying to catch a particular reversal or a particular change of the trend. Now this is where these indicators come in, and they do a good job. They can do a good job. However, you need to note that that doesn't mean that all the time that they have to be right. No, 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 no. Sometimes, sometimes you have to, and this is why I talk about I talk about confluence. You need to check that several issues have aligned. Several things are all pointing to the same direction. All right, let's carry on and read what it says here. I have indicated something here, and it says in forex trading, combining multiple indicators and analytical techniques can provide a comprehensive view of market conditions and enhance decision-making process. However, it's essential to understand that no indicator can predict future price movements with certainty, and traders should exercise caution and consider multiple factors when making trading decisions. So you don't look at one thing and think that that's it. No, 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 no. Or rather, you should depend on various indicators, or you should look at various factors. Look at the indicators, but also look at other market structure issues. Look at the candles, look at the behavior of the market. Get to incorporate, that's the technical. Now get to incorporate what the fundamental information is, and we will look at that in module 2 or thereabout. But for this module, we are going to move into the next lesson, which is none other but RSI. So look out for RSI. Let's understand what um, relative strength index is all about. It's going to be a good class. Have a good time. Thank you.